Hello everybody, this is Toni Turner and welcome to the market now as of about noon Eastern on Friday, February 23rd. Well, the Wall Street's main indexes are rising so far today, with gains in technology stocks clawing back some of the week's losses, which were sparked by concerns about inflation and interest rates. Soaring shares of Hewlett-Packard Enterprise and HP, the two companies created from the split of Hewlett-Packard Company in 2015, are a major force so far today behind this surge in technology stocks. Both companies reported strong results on Thursday, yesterday, with HPE also announcing a plan to return $7 billion to shareholders. And now on that note, let's go on to three charts that could give us some insight into the week to come. First of all, as we always do, we're going to look at a daily chart of the S&P 500 SPDR, symbol SPY. Of course, this is the exchange-traded fund that closely follows our S&P 500 benchmark index. Now, as you remember, on January 26th, the S&P made an the SPY, I should say, made an all-time closing high of $286.58, or about 28.65 on the S&P 500 itself. Now, as you probably know, we had a very steep drop after that all-time high. The SPY fell down to its 200-day moving average, fell down to actually a low that day of $252.92. Then rallied on the back of short covering and some buy the dippers coming in, rallied right back up to the green line on this screen, which is the 50-day moving average, the 50-day simple moving average. We also see here the red line coming overhead, the 20-day moving average. We see support down here that was offered by the black line, the 200-day simple moving average. Right up here where price is, when I captured it today, price for the SPY was trading at $272.26, or about $27.22 on the S&P 500 itself. Now you see here we have a relatively strong trend line coming up right where the 50-day moving average is, right where the 20-day moving average is. Excuse me. So all of this together is creating pretty tough resistance for the SPY, and so far the trend line, the 20-day, the 50-day are all rejecting, very successfully I might add, they're all rejecting SPY price. They're all kind of pushing it down, offering a ceiling, keeping it at least up till right now down below this $272 area at very strong resistance here so far. Now the question is, can the SPY maintain this altitude, and in the coming week, can it break above 273 and start back up for its prior highs, or is it going to have to maybe give up a little bit, move back down, and retest part of these prior lows? Now the game is here, price likes to go back a lot of times, or try to go back to where it's been before. So we could go either way here depending on what happens. In the coming week, there's quite a few economic reports I'll tell you about later. One more interesting thing here that it's a technical pattern a lot of people don't know about or discuss. It's called a diamond. And a diamond, again, is a price pattern that has a relatively significant negative connotation to it. And you can see here how the diamond pattern has formed. Again, it's not something we talk about a lot in technical analysis, but it does have a negative connotation. Doesn't mean price can't move back up and break out of this diamond pattern, because it certainly can. But because of the diamond pattern's negative connotation, and because of a lot of other factors we see here, in the coming week when I get into any new long positions, if I do, I'm definitely going to keep my share size small and put in firm stops, probably hard stops with my broker, because this again is a pattern we don't see very often, although we're seeing a lot of it recently in equities and ETFs. We're seeing this diamond pattern. So we just want to be careful and give it some respect until we see, again, if the SPY has legs in the coming week, if it can move higher, break out, break above 272, and start back up. If it cannot, it may have to take a rest here and move down to retest part, hopefully not all, of these prior lows. So with that, let's go on to our next chart. Today we're going to look at the PowerShares QQQ. As you all know, this is the ETF representative of the NASDAQ 100, very important index in the market. The FANG stocks, which a lot of times definitely support the QQQ or the NASDAQ 100, the FANG stocks by that, I mean, of course, Facebook, Apple, Alphabet, Netflix, those kinds of guys. They have been stronger than the overall SPY, and you can see that because the Qs are trading right now above their 20-day moving average, certainly above the 50-day moving average. And the trend line that I just drew here, we touched it 4 times, so it's strong. And right now the trend line, of course, is mimicking, like much of it did with the SPY, the 50-day moving average. So it's coming down here. Now with the SPY, all of these, the trend line moving averages were above it, causing resistance. Right now for the Qs, these lines are all below price, which can provide potential support. When I captured the QQQ today, it was trading at $166.29. Question is, in the coming week, it's consolidating here. Can the Qs break out above 166 and try to move back up to the prior highs up at about 170? Or, excuse me, will the Qs, like potentially the SPY, have to move down and retest some of this prior move up from the 200-day moving average? So we're at an inflection point here for the Qs and the SPY. The coming week is going to tell us a lot. Again, I would suggest being reasonably cautious here and definitely trading with firm stops. Our last chart for the day is one we haven't looked at in a long, long time, for good reason. This is the Energy Select Sector Spider Fund, XLE. It has 32 holdings in it. The top holdings are ExxonMobil, Chevron, Schlumberger, EOG, and ConocoPhillips. Now, it made a relative low in August of last year at 61.80, and of course a lot of this was on the lows of oil prices moving lower. Since then it has rallied, moving up back over in last winter, back over its 50-day moving average, and then rallying on the price of oil moving higher in a near parabolic move, and moved up to the recent closing high on January 22nd of 78.03. Then it, to add to the excitement, it rolled over and fell down as dramatically as it rose, maybe even more so. Fell down to the 200-day moving average, punctured it, fell below it, and is now struggling to move back up and move back over this 200-day line. This was a pretty neat fall here, and a lot of it was on the back of the big energy companies reporting less than sterling earnings. Exxon certainly did that, and a lot of the others. So now we see that the XLE is trying to build a base here. I want to see in the coming week if it's successful. This base is forming on a low here of about 66.60 or 50 on the XLE. Today it's trying to move back up above its 200-day moving average, and when I captured this chart, the price of the XLE was $67.91, with the 200-day moving average coming in at $67.90. What I'm looking for it to do, if it can hold price support here, if it can move up in the coming week back over the 200-day moving average, if it can break above 68.50 and head back up towards 69 and do so on decent volume, that's what I'm going to be watching for. If the XLE can do that, of course it would be nice if oil prices are rising too. If the XLE can do that, I may add a small share size of the XLE to my portfolio. I will use the 200-day moving average, a close below that, as my protective stop. So if price rolls over and closes back below the 200-day moving average, I'll jump back out until I see when or if the XLE is successful and starting to rally back higher. So again, I may add shares next week if it heads up to 69 with my protective stop under the 200-day moving average. So we want to be careful with this. We want to do it in the right way. Bottom fishing moves can be a little bit tricky, but as long as you use good risk discipline, they can also be very, very profitable. And now let's go on to the coming week's economic reports. But first, something that's going to tie right into what I was just talking to you about. I want to alert you to an exciting opportunity. This is a perfect time to check out my online training, how to bottom fish like a pro. We are offering this training right now at a 20% discount. And I say this is the perfect time because recent volatility in the market has beaten down a flurry of high-quality stocks, some of them energy stocks like I just showed you in the XLE, and these stocks are ripe for the picking as long as you know how to do it. It's not hard to do, but you have to know how. With this training, you will discover quickly and easily how to spot stocks that have sold off and are ready to reverse higher again and could give you profits of 20, 30, 40% or more. So check out this offer by clicking on the button below. And now we'll go on to the coming week's economic reports. On Monday, we're going to have new home sales. Tuesday, we'll see durable orders and consumer confidence. Wednesday, we will see the fourth quarter GDP, pending home sales, and our usual crude inventories. Thursday is a busy day. It's the first day of March. We'll see our usual jobless claims, the natural gas inventories we usually see, auto and truck sales, PCE prices, and of course the ISM Manufacturing Index. On Friday, we'll have the Michigan Sentiment Index. Again, you'll want to check out how to bottom fish like a pro. A special offer available right now and only for the next couple of days. Learn how to buy low and sell high. Finally, learn how to do that. My approach is an easy-to-learn approach to the market that can make you more profitable from now on. Click on the button below to find out how. Until next week, keep green on your screen. I'm Toni Turner, and this is The Market Now.